Thanks very much, Jasper, and thanks everyone for taking the time to hear a little bit about Equinox Gold. I think probably some of you are somewhat familiar with the company. Equinox Gold trades on the TSX under the symbol EQX, or the NYSE Americas under the symbol EQX. I'll start. Slide sharing here. As you can see, I will be making some forward-looking statements. Please do take the time to take a look at that on our website. And I suspect that maybe Jasper will share a copy of the PDF as well. So very interesting time for the company and a very interesting time for the gold sector as a whole. Gold has been performing very, very well over the last few years. As gold investors are probably quite familiar, I think over the last 3 years, gold is up approximately 80%. And of course, Equinox Gold is a 100% focused gold producer, explorer, and developer of assets globally. Interestingly, we just completed a strategic merger with Calibre mining to expand our gold production. And what has happened through this transaction is we have enhanced the portfolio by way of a significant portion of our net asset value or gold production and assets are now in Canada and the United States. And typically for gold investors or investors in general, having tier one mining jurisdictions of Canada and the United States is important, but it is also important because that drives valuation. Very, very often and typically, assets that are located in Canada with long life, low cost, and good exploration upside drive valuations, and I'll get into that briefly. But you can see here on the right-hand side by the pie chart, the asset portfolio is Brazil, the United States, Nicaragua, Mexico, and of course over 50% in Canada. With the transaction, the management team has changed. The new leadership is Darren Hall, who was the Chief Executive Officer, founder, and director of Calibre Mining. Now, I think it's important to give a little background and history on Darren Hall. So Darren has been in the mining business for over 40 years. Darren is a mining engineer. He spent over 30 years of his career operating and optimizing assets for Newmont Mining. Newmont is a globally recognized gold producer that produces gold all around the world. And so Darren was involved in optimizing a number of assets, a number of very large gold producing assets for Newmont. And at the end of his time with Newmont, he was overseeing about 15 to 20,000, I don't know exact number, people, not 8 or 9 Asia Pacific assets. And this represented approximately 50% of Newmont's EBITDA. So a tremendous track record, a significant amount of experience and expertise to look at the portfolio and drive value. So when we look forward and you look at the combined entity now, and based on analyst numbers and projections, we would anticipate, and this is not official guidance, but we would anticipate that the company now has the assets to drive significant value. But in 2026, we would expect somewhere between 900 and 1.1 million ounces of gold production. So a very exciting time for the company as we drive production growth with new assets coming online. So in Canada, we've got the Greenstone mine in Ontario that is ramping up to nameplate capacity. We would anticipate sometime during next year. And importantly, from the Calibre assets, the Valentine gold mine is now starting up. And that asset, based on a feasibility study, is set to produce approximately 200,000 ounces of gold a year. for about a 14-year mine life, and it also comes with tremendous exploration upside. At the same time, the company is focused on delevering and then returning capital to shareholders. And based on the current gold price and cash flow projections, we would be in a position potentially to start returning capital to shareholders within 18 to 24 months. On top of that, which in and itself is a very exciting catalyst, but on top of that, the company comes with some very significant organic growth. So there is no plans to do any additional acquisitions. I talked a little bit about the enhanced asset portfolio, and I want to compare Equinox Gold now to two tier one valued mining companies or gold mining companies that are fairly well known in the sector. I'll start with Agnico Eagle. Been around for decades. Has been driving value, trading at a over 1 times price to net asset value. In fact, at this date, at the end of June, was trading at about 1.6 times price to NAV, a significant valuation. And the company has a stellar reputation. You can see all the metrics there, generating strong free cash flow, returning capital to shareholders, tier one jurisdictions. And now when we look at Alamos Gold, a mid-tier gold producer with about 450 to 500, actually to 600,000 ounces of gold production with organic growth, you can see as well, trading over 1 times NAV, trading at here in this at this date over $17,000 per EV per ounce of production. So driving a lot of value for Alamos shareholders. Again, paying a dividend, returning capital to shareholders. But what's important here when we look at the key metrics: tier one jurisdiction, substantial long life assets, free cash flow, operating track record, returning capital to shareholders, and then the valuation metrics. We can see that Equinox Gold, based on those metrics, does fall into these critical or key metric categories. We can see that the opportunity for a revaluation for the company, assuming that we can deliver on those expectations, driven by Darren Hall's leadership and Darren Hall's team. We've got a new chief operating officer overseeing these assets, David Schumer. I have worked with Darren now for over 10 years, so I have seen him drive this discipline to delivery and delivering on commitments, as we did with Calibre Mining, and I came from Calibre Mining as well. So I believe this presents a very compelling opportunity for Equinox and Equinox Gold and their shareholders. Darren and myself and a number of the leadership team are significant shareholders of the company, and we believe there's very good exploration or very good shareholder value returns in front of us. Again, on some metrics here, you can see that on a price to NAV or an enterprise value to ounce of production over the next couple of years and EBITDA growth, there is a significant opportunity when comparing ourselves against our peer group. This is dated June the 30th, 2025. So we have seen some share price performance since then as we reported our Q2 results. But needless to say, I believe this presents an opportunity for a significant amount of re-rating. And again, I want to preface this by the company has to deliver on the expectations that we've provided to the market. We have to deliver on quarter-over-quarter results, deliver on annual guidance, and continue to delever the balance sheet. And I believe that we will continue to start to re-rate. On overview of the asset portfolio, I think again that there's probably a number of folks that will watch this presentation that are familiar with. But 7 production complexes, 5 growth opportunities, over 20 million ounces in reserves, over an additional 20 million ounces in measured and indicated resources. Our guidance for 2025, midpoint is about 850,000 ounces of gold for 2025. And this includes the Calibre assets from January 1 through to December 31st. Now, I say that because the deal closed on June 17th. Now, typically what happens is from June the 17th, that's when the assets will attribute to the income statement and the cash flow statement. So it is important to note that we are saying that this production profile and this cost profile is based on January 1st through to December 31st. Next year in 2026, we won't be going through the same stub period from an accounting perspective. Nonetheless, I just wanted to point that out. Calibre came with assets in Nicaragua, Limon, and Libertad. Came with the Pan producing asset in Nevada, along with the Gold Rock development stage asset, and then the 2 million ounce Golden Eagle development stage asset in Washington. We have recently announced the transaction for our Nevada assets. So one step closer to continuing to delever the balance sheet. That announcement was a few weeks ago. So we announced that it has been transacted with Minera Alamos for $115 million US in cash and shares, predominantly cash, so $90 million US in cash. And we would expect that deal to close sometime during Q4 of this year. And then I'll point your attention to the, as we talked about, over 50% of our value coming from two Canadian assets. Up in the top right-hand corner here, located in Newfoundland and Labrador, is the Valentine gold mine that is just starting first gold production, as well as the Greenstone asset that has been producing and ramping up to nameplate capacity. We would anticipate that hitting expected run rates by Q1 or Q2 of 2026. Where does that put us now with the life of mine average at Greenstone around 300 to 330,000 ounces, and the life of mine at Valentine around 180 to 200,000 ounces a year? That puts us firmly, as of today, puts us firmly in the second largest gold producer in Canada. So a pretty substantial step towards a tier one gold mining valuation. And it does take time to ramp up these mines, but we would anticipate that we would get these assets ramped up by the first half of 2026. And then, if all goes according to plan, be producing approximately 500,000 ounces a year on an annualized basis from these two assets. A Greenstone, this year, midpoint of guidance is 240,000 ounces, and again, continuing to ramp up the asset. What we're doing here is ramping up the mine to approximately 200,000 tons per day coming out of the open pits. And the goal is to ramp up to about 25,000 tons per day being processed through the process plant. We would really like to push it. So next year in 2026, go between 200 and 225,000 tons a day out of the open pit. And the nameplate of the process plant is 27,000 tons a day. But you can see a substantial mine life there over 15 years, 5.7 million ounces in reserves, and the life of mine average about 330,000 ounces a year. Valentine, a little bit smaller, but still a substantial tier one asset. Life of mine average about 180,000 ounces. Now, for the first 12 years of the 14-year mine life or reserve life, we've got about 195,000 ounces of gold a year. So substantial asset. One thing I will mention that I'm familiar with this one, I'm close to the Valentine asset as it came out of the Calibre portfolio, is that there's substantial exploration upside here. One example includes some results that Calibre put out at the end of 2024. Just before we announced this transaction in Q1 of 2025, the company intercepted outside of resources and outside of reserves. We hit 172 meters of 2.4 grams per ton gold, 90 meters of 2.1, 50 meters of 3 grams per ton gold in an area about a kilometer south of the furthest pit. So it does demonstrate some very good exploration upside. Most of the drilling has been done between 6 and 8 kilometers of a 32-kilometer major fault system. So it does present some significant upside. And we will continue to invest across all of the portfolio. But Valentine is showing already demonstrating that exploration potential. As we continue to advance and get to nameplate of these assets, and this is all based on analyst estimates, you can see that 25, 26, cost profile starts to come down, cash flow production profile starts to come up, expediting our ability to delever the balance sheet and then hopefully get into a position where we can return capital to shareholders. And this would be based on analyst expectations for the price of gold as well. And I believe the average is sitting around $3,000 per ounce. Currently today, gold is trading around $3,350 per ounce. In addition to all of what we've talked about here, we've talked a little bit about the Valentine upside. So we're now starting production from that. We've invested all the capital into the initial project capital for that asset. Now we're going to start realizing the cash flow generation that comes from it. In addition to that, we've got organic growth from the Castle Mountain asset, which is located in San Bernardino, California. This has been a smaller heap leach asset, is currently being re-leached. But now the company is working on the expansion potential of this asset and going through permitting of that. We've recently been put in what's called the Fast 41 permitting process. So a few months ago, the administration of the United States signed an executive order where assets could be fast-tracked, critical metals could be fast-tracked, and gold has fallen into that category. We have received the approval for the Fast 41, and we would expect a record of decision by December of 2026. And we would anticipate that state permits would come within 6 months following that. Following a positive outcome there, Castle Mountain would go through construction, approximately 1.5 to 2 years, and then that asset would be producing over 200,000 ounces of gold a year. And finally, the Los Filos asset. This is a very, in my view, a gem within the portfolio. The asset is located in Guerrero, Mexico. It is currently on care and maintenance as we work through final and hopefully negotiations with all 3 of our communities, but the company has been working ahead with a 2-community plan out of a 3-community area. As you can see here, based on a feasibility study, the asset, once a CIL plant is put in place there, and currently it has been a heap leach operation for the last number of years, but a CIL plant has been permitted and approved. There are auxiliary permits that are required, but the asset is still currently on care and maintenance as we advance a 2-community plan and continue negotiations with a 3rd community. Nonetheless, this asset could produce approximately 280,000 ounces of gold production a year with the 3-community plan. We are assessing a 2-community plan. So we are going to start exploration activities and some technical studies looking at what a 2-community plan could look like there as well. So within a fairly large portfolio, there's some good organic growth potential. So the company does not need to go out and acquire any additional assets. I talked a little bit about exploration. We view ourselves as an exploration company driven by several $billion a year of revenue. So we believe that there is good organic growth within our portfolio from an exploration perspective. And if you were to look at Calibre Mining, we started in Central America, in Nicaragua. That company had, at the time of becoming a gold producer in 2019, had roughly 50 to 100,000 ounces of reserves, 2 mills, large land package. And through operational excellence, we were able to drive operating cash flow and then drive reinvestment into exploration and development. So over the course of 2019 through to the deal with Equinox Gold, the company produced over 1 million ounces of gold. And at the end of 2024, had 1.1 million ounces of reserves on the books as well. So unlocking significant value through exploration. And I believe that is potential across all of the assets within the current portfolio. And we'll be investing a approximately $100 an ounce a year into exploration. So finally, I think that provides a very good overview of Equinox. We're building a top quartile valued gold company through discipline, through delivering on our commitments, and unlocking the true potential and value of this portfolio. With gold at over $3,000 an ounce and production and cash flow growth growing, I believe that Equinox is an incredible opportunity. I'm very excited to be a part of it and happy to answer any questions. So with that, I'll turn the presentation back over to Jasper. Thank you, Jasper.
Ryan, could you tell us first who you are and tell us about your career?
Okay, who I am. So I've been in the mining business for a little over 20 years now. I got involved in the business through a gentleman by the name of Blaine Johnson and Doug Forrester. Blaine, most recently, is the founder with myself, Doug, and Darren of Calibre Mining. So the company that Equinox most recently acquired, or I should say merged with, in a business combination. Blaine got me into the business in probably 2003, 2004. I have a business background, and I just wanted to learn about mining. I wanted to learn about investments in mining, taking companies public. So I started my career at that time in a company called Terrain Metals. Terrain Metals was an asset that was divested by Goldcorp, a large copper and gold asset in central British Columbia. And in fact, we were able to assemble a very strong team and advance that asset through different levels of feasibility studies, permitting, and then actually sold it to Thompson Creek. That became, Thompson Creek was acquired by Centerra, and Centerra is the owner of the Mount Milligan asset and is producing copper and gold from it now. We then went on and I think we started a company called Edgewater Exploration, bit of an interesting name for a mining venture. But nonetheless, we acquired assets in Spain and West Africa. And this was probably 2010, right on the kind of close to the peak of the last gold run. That unfortunately hasn't worked out as well. That being said, we have divested of the West African assets into another vehicle called New Core Gold, which is I think they're almost up to 2 million ounces of gold now. I'm a director, one of the founders of that company, and it's being advanced by Luke Alexander, so I'm on the board of that. A very exciting asset in West Africa, in Ghana, one of the best countries there, along with Doug Forrester and Blaine Johnson. And, during this time, Calibre Mining was actually formed. Calibre Mining was formed in 2008, 2009 as an exploration company with assets in Nicaragua. That's when we acquired the Nicaraguan assets. And we had advanced that through a number of, it was kind of a prospect generator, if you will, where we had a number of assets where we had JV interest and we had JV partners. Centerra was a JV partner. I Am Gold at one point was a JV partner. B2 Gold at one point in time was a JV partner. And at the very end in 2020, Rio Tinto was a JV partner and looking for these, copper, gold, large porphyry type assets in Central America. We also did a deal called New Market Gold, which was a great success. New Market Gold, Doug, Blaine founded that company. They had a number of well-known mining entrepreneurs involved as well. Ray Threlkeld, Randall Oliphant, Lucas Lundin, where we acquired 3 producing assets. And again, they weren't great assets. They were undercapitalized, underexplored. And one of them turned out to be a mine called Fosterville, which is, I think, a few years on, was one of the highest grade underground gold mines in the world. And we merged that New Market Gold company with Kirkland Lake Gold. And on the back of that merger, the company was the best performing gold stock in the world. It went from about $5 Canadian a share to about $65 Canadian a share. and a tremendous success for all shareholders. So we look forward to the future of Equinox, given the M&A track record of the team, obviously the sound and wise Ross Beatty with his tremendous track record of creating wealth for shareholders, along with Doug and Blaine. They complement each other, and I believe really see the significant upside. And so that's right up to the end of Calibre Mining merging with Equinox Gold. I've been in the business for over almost 25 years now.
What's the rationale for the merger, and why was that creative for both companies?
Yeah, the rationale was really to find ways to unlock additional value. When you look at the portfolio now, as I mentioned in the presentation, you're bringing on a second significant Canadian asset with very good exploration upside, and right at the beginning of its mine life, right? So you're now ratcheting up the portfolio or enhancing the portfolio to again bring in tier one jurisdictional assets with long life, good cost structures, good exploration upside, an established operating team. And so from both companies' perspectives, bringing the company together as a merger of equals was an important aspect, because we did the exact same thing with Newmarket Gold and Kirkland Lake Gold in 2017. And again, that company went on to see significant returns for shareholders. So if you look out 6 months, a year, 2 years, 3 years from now, assuming current gold prices, we have majority of our net asset value coming out of Canada and in fact North America, with the inclusion of the Castle Mountain asset, the Mesquite asset. So importantly, you've got and again, as I've mentioned this, Alamos, most of their production comes out of Canada. Agnico Eagle, most of their production comes out of Canada. With the inclusion of Valentine and Greenstone, and again, this isn't guidance, but based on the technical reports of around 330 and 180, you're over 500,000 ounces coming out of Canada, so tier one mining jurisdictions. And as we've seen by our peer group, most of those are getting tremendous valuations. And therefore, that's part of the reason why this deal made so much sense with new, substantial, long life assets in Canada.
So essentially, yes, you've touched base on the management transition. So Darren Hall, previous CEO of Calibre, coming in, and David Schumer from Calibre taking over as CEO. Could you add some color? Essentially, if you look at the management team right now, it's more or less, at least on the technical side, more from Calibre's side team.
Well, I mean, if you look at the C-suite at this point, sure, but all of the key people remain at all of the assets. There has been some augmentation. There has been some additions. I know David has brought in some technical expertise at the Greenstone asset to assist with blasting, timing, and design, to assist with mining, double-side loading. Tom Gallo, also head of technical services and growth, comes from the Calibre side. But it's a combined team effort. There's excellent talent across the whole company and across all of the asset portfolio, led by all of the critical general managers. So no, at the corporate level, sure, there's a few additional Calibre people here, but what's happened, if you look back over the last 10 years, is Greg Smith and the team at Equinox have assembled this large portfolio, and incredibly good at mergers, acquisitions, and building up this portfolio here. Darren and Dave's skill set is now delivering the operations. So that's what Darren has done his whole career, is delivering production, delivering that into those expectations. And I believe that's what he'll bring into the Equinox portfolio.
Excellent. So could you summarize the new capital structure?
Yeah, capital structures. So the company at the end of June had a little over $400 million in cash, $1.8 billion of debt between a term loan, revolving credit facility, as well as convertible debentures. The company has a net debt position of about $1.4 billion. And about 770 million shares issued and outstanding. So putting the company at about as of right now, about an 8 billion Canadian market capitalization, or little under 6 maybe US market capitalization. So that's where the company currently sits, and the focus is on delevering that balance sheet. So with the inclusion of Valentine, the ramping up of Greenstone, if we were to say, let's just use big round numbers. Again, this isn't guidance, but approximately 1 million ounces of gold production a year. Let's use $3,000 an ounce into the revenue stream. Let's use $2,000 an ounce. Now, again, this isn't guidance, and I would anticipate costs to come down. But if you were to use $2,000 all in cost in the business, that's generating $1 billion of operating cash flow a year. So you can anticipate that the delevering happens fairly quickly, and you start to get into a position to return capital to shareholders. So, that's where the balance sheet sits at this point in time. And, I'm sure that you'll see and hear regular updates from the company as we continue to work towards delevering, delivering on our commitments, and generating solid returns for shareholders.
Let's quickly summarize Q2. I think if you could give us the key figures and takeaways from Q2.
Sure. Key figures here. I think probably what we should start off with is the bigger picture. The company is ramping up the Greenstone mine. So the year's guidance for Greenstone was 220 to 260,000 ounces, right? We're on track to deliver that production outlook. And I think the all-in sustaining cost was $1,700 to $1,800 an ounce. So we're on track for that. H2 is expected to be stronger than H1. And the primary reason there is material movement. Q1, there was about 130,000 tons a day moved out of the mine. Q2, we were up to 180. And in Q3, we're on track for 180 to 200,000 tons a day. So you're starting to see the material movement happening in the ramp up. At the same time, we're seeing the volumes going through the mill. The recovery is increasing. So this asset is beginning to get closer and closer to nameplate capacity. When we step back, and again, we look at assuming that we did this deal January 1st, the production from Q2 was about 219,000 ounces. But importantly, the only amount that's attributable on the income statement and the cash flow statement is about 150,000 ounces because the deal was closed June the 17th. So total cash cost for the period was just a little under $1,500 an ounce. And total all-in sustaining cost was $1,960 an ounce. And again, as we look forward to Q3 and Q4, we would expect it to be in around that range and possibly a little better. Again, the important factor there is the continued ramp up of Greenstone, but also, secondly, we have not given any guidance to our Valentine mine, but we are on track for first gold coming out of there any week now. So on track, I should say, for first ore through the plant. And then 4 weeks later, we would see first gold. But importantly, income from operations, 160 million. I talked a little bit about the cash. Our cash position sitting around 400 million. Adjusted net income for the period was a little under 60 million. So adjusted EBITDA, $200 million. So again, seeing that ramp up, getting closer and closer to nameplate, driving that operating cash flow, driving those costs down for Q2.
When do you expect Greenstone to be? I mean, you processed, I think, roughly 2 million tons of ore in Q2, so 2,200, 22,000 tons per day, give or take. And nameplate is 27,000 tons per day. Do you expect to get there, or do you will always be a little bit above because of mill availability?
Well, as we continue to ramp up, we'll see any of the challenges or hurdles, but and obviously learn from that and work to overcome that. One of the things that we did in Q3 here for the first week of July is we shut the mill down and did some different work that was required. Since that shutdown, we've started to see additional tons going through the plant, right? So I think that the goal is to get around 24 to 25,000 tons per day for Q3 and Q4. 27,000 tons a day. I would expect that we'll get closer and closer to that in 2026. So I would hope that by the end of Q2 of next year, we're getting close to 27,000 tons a day. I believe that there's opportunities to push it beyond that. And then equally as well at the mine, we would expect, or we would like to see the mine doing about 215 to 225,000 tons per day out of the mine. So once we get there, that will be getting to nameplate capacity. It should be sometime Q1, Q2 of next year.
And also recoveries. I mean, you have improved recoveries that are at 85% as per Q2. Technical report status at 91%. So how do you see the recoveries changing going forward?
Well, again, I think the technical study said that the last technical report said around 90% recoveries. We would like to see the long-term averages hopefully getting there, but realistically, we're expecting it in the high 80s, probably 88, 87, 89% recoveries in that ballpark.
You haven't guided for this, but what is sort of the expected all-in sustaining cost once fully ramped up? You said 330,000 ounces per year on average as per the technical report.
Well, as per the technical report, yeah, the life of mine average is around 300 to 330. And, as I hear Darren looking at this and talking to investors and then publicly on conference calls about this, we would anticipate that the average annual production is somewhere between 275 and 330,000 ounces. And I know that's a bigger range right now, but as we ramp it up and understand all aspects of the asset, we'll be able to provide more clarity on that. So with that, we would expect somewhere in 2026, for example, we would anticipate something like 275 to 300,000 ounces. And when you get there, we should be somewhere in the $1,400 to $1,500 all-in sustaining cost.
In terms of Valentine, I mean, Valentine is in commissioning. When do you expect first gold pour, and how long is the expected ramp-up period? And what is sort of, if you also could remind us of the sort of the production run rate once fully ramped up, and cost profile?
Yeah, so Valentine is located in the central region of Newfoundland. Newfoundland and Labrador has quite a rich mining history. This is probably the first new mine in maybe over a decade or two. So it's a very large driver of local and regional economy. We have invested between ourselves and the previous owner, Marathon Gold, hundreds of millions of dollars in investing in drilling, in permitting, engineering, and now plant construction and mine construction. So we're right at the finish line now. I mean, there will be things that come up. Anytime you commission a new plant in any business, there will be things that come up. But this is a 2.5 million ton per annum plant that has that capacity of throughput. In the study, we had engineered it to go to 4 million tons, I think by year 2028, 2029. So very likely we'll have a phase 2 to this plant. It might be bigger than what was originally anticipated because the exploration potential on this property is quite vast. But we're at the finish line now. We would anticipate ore beginning to go through the plant. So for example, right now, the primary crusher is commissioned. The mine is operating. We're mining from the Leprechaun and Marathon open pits. It's a 3-pit mine plan. So Marathon, Berry, and Leprechaun. We're just clearing the Berry pit now. So you'll have the 3 pits operating sequentially. And based on the study, you have an annualized run rate of approximately 195,000 ounces. And in the study, it said that all-in sustaining costs would be a little over $1,000 an ounce to produce an ounce of gold, which, as you know, at these current gold prices would have a tremendous margin. What I want to caution right now is as we have worked through this over the last year and as we've been benchmarking against other assets in Canada, the $1,000 an ounce is probably a little bit optimistic. So we would expect, once up and running, and in a little bit of a forward-looking statement here, but we would expect once up and running that Valentine's probably going to be in that $1,400 maybe $1,500 all-in sustaining cost to produce ounces there. There's 2.7 million ounces in reserve. There's a total of 4 million ounces in measured and indicated resources, inclusive of those reserves. And then there's about 1 million ounces in inferred resources, so a total of 5 million ounces. So I anticipate that we'll probably be there longer than the study anticipated. So that was about 14 years in the reserve life of 2.7 million ounces. We'll likely be mining there longer. Again, it's going to be dependent on the price of gold. But additionally, I think that because I mentioned there's very good exploration upside, well, Calibre, prior to the merger with Equinox Gold, already discovered a new zone of mineralization. The big Valentine Lake Fault is 32 kilometers long. The deposits sit over 6 kilometers of that fault, with largely most of the remainder of the fault underexplored. Well, Calibre discovered mineralization about a kilometer to the south of Leprechaun, and we hit 172 meters of a little over 2 grams per ton gold. We hit 40 meters of 3 grams, 90 meters of 2 grams. So starting to get into what looks like the potential for another new whole zone. And that's outside of resources and reserves. So it looks like some very good potential at Valentine. First gold, though, would come approximately a month, 6 weeks later from the ore going through the plant, which would put us at, if we have first ore going through the plant very, very soon, right at the end of Q3 or early Q4, where first gold would start coming out of the plant.
And how long is the expected ramp up, if you are conservative?
Well, assuming that we have no major issues that come up, and again, there are issues that can and will come up, but assuming that this is a fairly simple plant, it's a crush, grind, and then a CIL process. So a simpler plant, a smaller plant than Greenstone, probably about 25% of the size. And so we would expect Q3, Q4, and well into Q1, ramping this asset up to that nameplate run rate. So probably by Q2, I'm going to say Q1, but let's say Q2 of 2026, we should be at that nameplate capacity. And that would give us, on an annualized basis, around 180 to 200,000 ounces of gold production.
Let's also talk about your Nicaragua operation. I mean, for those who watched our last interview last year with Ross Beatty and they are not familiar with your Nicaragua operations, I think it would be good if you could give us an overview. I mean, there's a hub and spoke operation there. So gold only. How does it work? What's the production profile, mine life, cost? How do you deal with artisanal miners, etc.?
Okay, let's give a little bit of history for your audience, because as you said, some are not really particularly familiar with the region and or the assets. So Calibre acquired these assets from B2 Gold in 2019, in the fourth quarter of 2019. When we acquired them, Calibre had been an exploration company in country for a number of years, and it had outlined different open pit and underground resources around the country in the past 10 years. So I think we had a little over 1 million ounces in various categories of resources in different open pit and underground deposits around Nicaragua, predominantly in the northern part of Nicaragua. B2 Gold had operated there for 10 years and produced an average of 150 to 200,000 ounces a year for 10 years. So it does have an established mining legislation. It did have a very good rule of law there when it comes to mining. And you brought up artisanal miners. Interestingly, artisanal miners in the mining code do have access to 1% of any mineral concession to mine from that area. And as industrial mining gets into those regions, potentially, you can relocate and work with small miners and support by helping them find new areas to mine. So it's a really decent system. Actually, if you look into the World Gold Council and what Calibre had done with small miners or artisanal miners, we're actually recognized for some of the work that we had done with the artisanal miners and working collaboratively with them. It's actually a very important part of their livelihood. And so we would look at ways of training and looking at safety support
And so I think it's a very, very small percentage of the production profile, less than 1% or maybe around 1%, where we do a serious amount of checking with regards to the people that we would be buying product from, and in some cases we buy the rock material, such that we're taking it out of, kind of a more, if you think about traditional artisanal mining, it is using mercury to unlock the gold from the rock. So, and then obviously that then goes into rivers or streams or lakes. So what the government wants to do is try to get that out of that system and have more small miners working with some of the larger industrial miners to take some of that, environmental sensitive products out of those waterways. So, if you look at it from that perspective, maybe 1% of our ore was coming from small miners. And so working collaboratively with them, and I can't remember where on the World Gold Council website it is, but it's worth looking up. Back to what we did when we acquired the assets, Calibre at the time had probably in those two assets. So it's Limon, it's a 500,000 ton per annum plant with open pit and underground mines on the concession on the 25-year lease. Then at Libertad, it's a 2.2 million ton per annum plant. So a much larger plant than B2Gold built. Limon was there previous to B2Gold. And Libertad was actually heading towards closure. So the reason it was heading towards closure in 2019, 2020 was because it had run out of resources and reserves on the property to feed into that mill. Introduced Darren into the mix as chief executive officer. Darren brings a tremendous amount of expertise and experience, and he's implemented different operating strategies. One of the things he looked at was these were two separate entities with two completely separate teams. There really wasn't a lot of communication or overlap between the two. And he saw that we had a bottleneck at Limon, meaning Limon could only process 500,000 tons a year of material, producing somewhere between 50 and 60,000 ounces of gold a year. Well, rather than expanding the size of the plant and spending hundreds of millions of dollars, Darren said, well, it'll cost us a little more on the operating cost, but let's see if we can mine at Limon and transport it on paved Pan American highways over to Libertad for processing. Similar mineralogy, similar process plants. So we begun that in 2020 by having a few trucks, 25-ton haul trucks on the highway to test it out. It worked very well, utilizing now a hub and spoke operating strategy. The hubs are the mills, the spokes are the satellites that feed into any one of those mills. And so over time, we evolved that. And actually, over time, I think we've had 7 or 8 major permits awarded. We have grown production 20% annualized year over year. We've gone from about 100,000 ounces of reserves to, at the end of 2024, 1.1 million ounces of reserves. We've produced 1 million ounces of gold over that period of time, all under Darren's leadership to unlock that value. But I think really importantly as well, Nicaragua is a mining jurisdiction. It's been one of the best mining jurisdictions I've worked in. It's been one of the best Darren has worked in. Strong, good rules of law and mining legislations. We are the largest industrial miner in the country at about 200 to 250,000 ounces a year there. We see good life in front of us, 4 to 5 years of reserves. But importantly, we continue to have very good exploration success at Libertad, as well as Eastern Borosi, which is the third satellite deposit that we brought on and permitted. We see good potential to extend mine life there. We see good potential to stay at a continued 200,000+ ounce a year run rate out of Nicaragua. And we will continue to invest in exploration and mine development there. So a great opportunity, good local workforce. I think it was 98% of our employees are local Nicaraguan. So really trying to benefit from the economy. It's been a great opportunity for us to realize the full potential, or maybe more than what was being realized in the marketplace for those assets when they were acquired.
Let's move to Los Filos. So, also to tie back to our last interview, at that time there was sort of a cliffhanger whether you would strike the agreement with the 3 local hero group or not. You struck with 2 but one remains. You have put it on care and maintenance.
Yes.
So I mean, right now you mentioned there was positive news in Q2. You mentioned that you're looking for an alternative development plant and location to build your CIL plant. Could you give some color on that? What's the plan for Los Filos going forward? And also, is there a reasonable possibility to actually get the third local group on board?
Right. Okay. Great questions. Let's start with Los Filos as a whole. I mean, there's lots of history at Los Filos. You look around in the region, Guerrera, Torex is operating very well. They've got a large copper gold asset there. Jody and the team at Torex have done a very good job. I think in total, probably are getting close to $4 billion market valuation for the Torex company, the assets. And then you look at what analysts have in their models for Los Filos, and currently I think it at the top valuation in net asset value is around $350 million. Some have it as a negative, as you just pointed out. We are currently on care and maintenance, and so on a monthly basis, we're spending anywhere between $2.5 to $5 million on that care and maintenance of the assets. And if we step back again and look at the total global resources in reserves, measured and indicated and inferred, I believe the number is north of 13 million ounces of gold in all categories. And if memory serves, this would be the fourth largest gold deposit in the Americas. So I believe there's tremendous value in this asset. But again, there's a history here. It has been an operating heap leach mine for a number of years. And what's happening now is less oxidized material is going on the pads. Therefore, it's driving up the operating cost, and the recoveries are getting lower and lower and lower, which again drives up those per ounce operating costs. And we know that the logical approach now would be to work through a process to get a CIL plant in place on site. We know that that's been permitted. There are auxiliary permits that are required, but based on a technical report, this asset with a CIL plant on site would be producing somewhere between 250 and 300,000 ounces a year of production. It is it likely needs a refresh, the study, which would likely lead to higher operating costs and higher capital costs to build this facility. But we think it's probably the right approach to do that because you'd get better recoveries. You'd probably have better gold production with the plants in place. So yes, there's 3 communities there. The Equinox Gold has now come to long-term, multi-decade agreements with 2 of the 3 communities. And we would continue to welcome negotiations and discussions with the 3rd community. We believe this is going to be a multi-decade asset that will be around for a long time to be able to support a number of communities and stakeholders. But as of right now, we are advancing a 2-community plan, which has recently been in the press locally there, and a press conference was held and supported by all local stakeholders, including government. And so what the company is doing is now we are assessing technically, environmentally, and from a permitting perspective, what that could look like from a 2-community plan. And importantly, the first step in that is to look at, on those 2 community and our own lands, to look at what is the exploration potential that could support assessing that plan. And so within a few weeks here, I would imagine that we have some exploration activities happening on those grounds. And as I mentioned in the beginning, when we look at those assets, yes, it's large amounts of resources and reserves, but the exploration potential is very vast. And so we'll see how that unfolds over time, but obviously welcome and encourage the 3rd community to have additional discussions. And under Darren Hall's leadership, very, very open and transparent, but also encouraging of working collaboratively in a fair and reasonable manner. So happy to do that. So we're working through a number of scenarios. We do see it as good value and good opportunity for the company. Yes, it's on care and maintenance, but we still see good opportunity to unlock value in that asset.
Let's talk about portfolio rationalization and optimization. You just sold the Pan Mine and Rock Gold project in Nevada, the Nevada assets for $115 million USD. Obviously, that makes sense for you. It's a small mining project. You got a good price. But so, could you talk about that and also talk about generally your view on portfolio optimization, if we should expect more sort of non-core or smaller assets to be divested?
Sure. Well, maybe I'll start with, and of course, the concept and vision of Equinox 1.0 was to build a solid portfolio and deliver 1 million ounce a year gold production. And we're at that point in time now with this portfolio that we could realize that original vision. Now, with Darren coming in and this strategic merger with Calibre Mining, we have the assets, we have enhanced the asset portfolio, in my view. We have the team to be able to unlock the portfolio and deliver the production profile that is expected. At the same time, we're at a fortunate position where we're at $3,300 per ounce gold, which is a great environment for divestitures. It's also a great environment for gold producers, as we're seeing record high margins. So if we take an example of another company, let's use Alamos Gold for an example. Obviously been around a long time, have a very good track record, have been prudent capital allocation strategists and experts. And so they are enjoying, some of their all-time high share prices. They've been delivering on the expectations of the market. And I think it's over 80% of their gold production comes out of Canada. So I'm not sure exactly what their guidance this year is, but I think it's around 600 to 650,000 ounces in 2025. And majority of that is coming from 2 cornerstone assets in Canada. And I think it's about 400 to 450,000 ounces of production out of Canada today. And I know they've got the growth profile with Magino. But as an example, there's a company that currently has a $16-17 billion market valuation, assets in Canada and Mexico. But if we were to take Equinox Gold, for example, and say when the Valentine Lake asset or Valentine Gold Mine is up and running at nameplate, which would be about 200,000 ounces a year of production, we take the Greenstone asset and that's ramped up, and let's call it life of mine average or thereabout, around 300,000 ounces a year. Call it 500,000 ounces a year in Canada at roughly $1,500 an ounce. Now, I'm making a bit of forward looking, but this is not guidance, but kind of what we're seeing right now and based on information we have at hand. That's roughly 500,000 ounces a year in line with an Alamos Gold that has a history, it has a track record. We have over $1 billion of debt. They do not. Right? They have been, returning capital to shareholders. We have not yet. But herein lies the opportunity. So today, Equinox has a market capitalization of roughly around $7 billion. We do have, as mentioned, the debt. So we've got to work to delever the balance sheet. But if you were to just look at those Canadian assets and compare, we should likely see a good re-rating on the back of that. But importantly, we have more production coming out of, as you just said, Nicaragua. We have additional production coming out of Brazil. We have additional production coming out of the United States. So we're at a position now where we start looking at that portfolio and what does drive share price performance. And what I'm seeing in the market, based on Alamos and Agnico Eagle and others, is that tier 1 mining jurisdictions, United States, Canada, Australia, and for good, long life, low cost assets, that drives valuation. We've seen a tremendous re-rate in IAM Gold recently because they're Côté Gold Mine. So in saying that, I think that there is opportunity to rationalize more of our portfolio. At this point in time, we're still doing our reviews, but maybe some of the higher cost assets, smaller assets, as we've demonstrated in the portfolio, can be divested of. But we really need to unlock the value such that we can delever. So, we're not running any processes or doing anything like that that puts any sort of specific time frame on it. That could be something for the future. But right now, we see solid production coming out of all of the regions. We see reasonable mine life in all of the regions. And there will be ways to optimize costs and different things. But I could see us doing something, in as I just mentioned, possibly a higher cost region or possibly a lower mine life region. But we still have to spend the time investigating, possibly reinvesting some dollars into exploration or mine development, because most of the capital has been put into the Canadian assets over the last 5 years. So is there opportunity like Calibre had done with the Nicaraguan assets? I think there is. But at $3,300 gold, if you could get, fair value in terms of cash to then delever a balance sheet for certain assets, I think you have to think pretty judiciously about that approach. So I think it's something that we'll very likely do over the next 6, 12, 18 months. That will delever and put us in a better position to then possibly return capital to shareholders more expeditiously.
So with that in mind, where do you envision Equinox Gold at the end of next year?
Well, in terms of production, in terms of assets, in terms of share price performance.
Your vision when you think of Equinox.
My vision. I think some of that will depend on how things unfold over the next 3, 6, 9 months. But I think I feel confident that we'll be in the 800,000 to 1 million ounce a year production profile. I think we'll see optimization in some of our costs. We'll see reinvestment back into the assets, probably in the tune of somewhere between $80 and $100 million reinvested into exploration. We'll continue to reinvest in assets, for example, Valentine Phase 2, into increasing throughput there. And I would anticipate that, we're possibly, very likely, in a position where we have divested of one asset, probably two now with the Pan asset already announced. If we can get that right value, we would probably move on that to expedite the delevering process. And I think that's going to be a very good thing from a share price performance perspective, if we can get the right value for it. If we can't, we'll continue to invest. And again, I would anticipate, whether it's Nicaragua, again, mine life there is 4 to 5 years, but we continue to find year over year because we reinvest into the assets. Brazil today is a little higher cost, but I bet you with some different strategic moves and reviews and optimization, those costs can come down. So, yeah, it'll be a continuous investigation and strategy review from the company. But I think comfortably we're now in that run rate with assets in the portfolio, 800,000 to 1 million ounces a year. Capital investment has been a thing over the last several years, going into building assets. We're now going to be in a more of a harvest mode to delever, return capital to shareholders, and reinvest in this portfolio. So there's no acquisitions on the horizon. There's no mergers. If anything, there might be some divestitures.